Get to those retail sales and the outlook for our economy. Richard Yetsenga is the Chief Economist with the ANZ Bank. Richard, thanks for your time. That stock market is kind of telling you that a lot of people have already banked in rate cuts from the Reserve Bank, doesn't it?
I guess so. I mean, the retail numbers today, and they're not alone, of course. Remember, unemployment's up a little bit. Jobs growth has been down quite sharply. The ANZ Indeed job ads series is suggesting that the unemployment rate will rise a bit further. I think all of these indicators say there's no realistic chance of any more rate hikes, and the market likes to bet on something, so it's going for cuts.
OK, but then go to those retail sales. Is this more about the consumer changing their behaviour, or is it that they have generally cut back now, which is what the Reserve Bank has always wanted them to do, and as a result you're seeing it through that retail sector?
Oh, there's both. There's the forest and there's the trees. The trees are this changed seasonality with November Black Friday sales pulling some sales into November. So we need to try and abstract from that. But the forest story is spending's been down. It's continuing to trend lower. It's part of that slower economic dynamic and consistent with the idea that the bank's trying really hard not to hike anymore. And I don't think they will. I think they're on hold now before we start to see some easings later.
OK, but out of the United States on Friday, there were very strong economic numbers, largely driven by consumers being more robust than what it was imagined they would be. We're seeing this slowdown in retail sales here, but we're not seeing unemployment. So what is the state of household finances right now?
Look, in aggregate, the household balance sheet is in the strongest shape I've really ever seen. Certainly, we have to go back at least 15 years to argue the household sector is stronger. Now, clearly, some households...
So that gives it capacity to continue to spend, doesn't it?
Well, it makes them more resilient to rate hikes.
Yes.
And with infrastructure spending associated with the climate transition, trying to deal with the housing affordability challenge, trying to ramp up defence spending, the export sector doing pretty well with commodity prices quite high. Somebody needs to give the economy some breathing room, and that's really been consumers, because a lot of those other areas of spending are proving even more resilient than the household sector. OK,
so then that would go to the government's argument that something has changed in the economy which justified the change in on the tax cuts. The question is whether pumping that money into low and middle income earners is where the hurt is, which is what we're seeing in these retail sales.
Look, I think there are distributional challenges in Australia. Clearly, I can talk about the household sector, kind of Joe and Helen average, but clearly there are households who are having a much more difficult time where kind of cost of living pressures might be a higher proportion of their take-home pay. I don't think it's unreasonable that policy is skewed towards targeting those sectors. I think the overwhelming message, though, is it's consumption, which is one of the primary areas of adjustment. We needed the economy to slow to get inflation back to target. We got some numbers out which hopefully will start to show that. All
right, so those numbers come out tomorrow with the inflation numbers coming out. They could potentially add to the argument that the economy is coming back to equilibrium, that inflation is coming back towards the band, and that's only going to add to the argument that there are more rate cuts coming, which adds more fuel to the stock market, more fuel to the property market.
Maybe. You're getting ahead of yourself. Let's see what the numbers say. I mean, the numbers will certainly say inflation has peaked and is coming down. As we know, the bank's worry hasn't been that it's not coming down. The question is it coming back to target quickly enough? I think it will suggest it's coming back to target quickly enough. And we don't just get quarterly consumer prices, we get monthly prices as well. So the market will probably extrapolate that monthly indicator a little bit. And that monthly indicator, for the first time in a couple of years, may well have a 3 in front of it, saying inflation is back to 3 point something. We want 3.0 or below to be consistent with the inflation target, but we're getting into that sort of territory now.
And just very quickly, I mean, there are 8 Reserve Bank meetings this year compared with the normal 11. Does that really change the momentum or the settings or what we imagine might come from the Reserve Bank?
I think, look, conceptually it should make some of the meetings less a toss of a coin, because on average you have 6 weeks between meetings, let's say, rather than 4 or 4.5 weeks. So there should be more certainty, I think, or less guesswork maybe about what the bank's likely to do at each meeting, because we'll have a bigger accumulation of evidence.
That is always a good thing to see. Less guesswork. I've got to say, Richard Yetsenga, it's always great having the program. Many thanks for your time today.